CME cuts silver margins 22% as vaults shed 6M ounces. Overnight, timing is suspicious. NFP, tomorrow 6 times. They made it expensive to hold silver, 6 consecutive margin hikes. That washed out the longs, crushed participation, and silenced the market. And then, overnight, 6 million ounces of physical silver vanished from the vaults. And the very next morning, they made it cheaper to enter this market again. Tomorrow, the jobs number drops. And nobody is asking the right question. Why now? Why this timing? And who, exactly, is positioned to benefit? Welcome to Financial Crisis Explained, the one place where the numbers speak and the noise stays outside. Now, before we go any further, if you have not subscribed to this channel yet, think of it this way. You would not skip your morning newspaper for 30 years and suddenly stop on the most important headline of the decade. Do not stop now. Hit that subscribe button, because what is coming in this video, you will want to be here for the next one too. And one more thing, drop in the comments right now, where in the world are you watching this from? Every city, every country, every time zone. Because this story does not respect borders. There's a rule in financial markets that most people never learn until it is too late. The rule is simple. It is never what they do. It is always when they do it. And what the CME did this week, it was not unusual. Margin cuts happen. Exchanges adjust requirements. That is normal. But the timing of this particular move is what every serious market participant should be studying right now. Let us build this from the ground up. A margin requirement is essentially a deposit. When a trader wants to hold a futures contract on silver, they do not pay the full value of that contract. They post a percentage, a margin, as collateral against their position. When the CME raises that margin requirement, they are making it more expensive to stay in the trade. Traders who cannot meet the higher deposit are forced out. Positions close. Participation drops. The market cools. That is the mechanism. Simple, deliberate, effective. Now here is where this story begins to demand serious attention. Between the recent metals rally and this week, the CME raised margin requirements on silver, not once, not twice, 6 consecutive times, 6 sequential hikes, each one designed to make holding silver futures more expensive, each one landing on traders who were already stretched, already leveraged, already watching their positions with increasingly thin breathing room. The effect was textbook. Open interest collapsed. Trading volumes contracted. The leveraged longs turned out the traders betting on silver's continued rise, got systematically removed from the market. Weak hands shaken out. Participation suppressed. The temperature of the market was deliberately and methodically reduced. 6 times. And then, after all of that, after the exchange spent months making this market smaller, quieter, and more expensive to operate in, they cut. A 22% reduction in silver margin requirements in a single move. Effective immediately after the close, gold margins trimmed from 9% to 7%, platinum adjusted as well. Across the board, one clean sweep in the opposite direction. Now ask the question that the financial media is not asking this week. Why now? Not 6 months ago when the rally was building momentum. Not 3 hikes in when participation was still healthy. Now, at the precise moment when registered silver inventory, sitting in a COMEX-approved vaults, is at one of its most critically stressed levels in recent memory. At the precise moment when physical silver is draining, not slowly, but at a rate that in any other environment would be generating front page coverage across every major financial publication. There are only 2 logical explanations for this sequence, and both of them are uncomfortable. The first is that the CME is attempting to bring paper traders back into a market that is quietly losing them. When physical metal drains and registered inventory tightens, the exchange needs volume, it needs participation, it needs the paper market to remain liquid and functional, because a paper market without participants is not a market, it is a problem. Reducing margins brings traders back, it lowers the cost of entry, it rebuilds the volume that 6 hikes quietly destroyed. The second explanation is more pointed and more worth sitting with. When physical squeeze risk is at its highest, when the gap between paper contracts and deliverable metal is widening, reducing margins makes it cheaper to hold short positions. Commercial entities, institutions with significant short exposure in this market, can now carry those positions at lower cost, precisely when the pressure against those positions is most intense. Neither of these interpretations requires conspiracy. Both of them require only one thing: attention, the kind of attention that does not come from headlines, but from sequencing, from asking not just what happened, but what happened before it, and what is being positioned after it. The margin cut is not the story. The margin cut is the signal, and the story it is pointing toward is sitting inside those vaults right now, draining overnight. 6 million ounces, gone. Physical silver disappearing. while paper markets get cheaper to enter. There is a number sitting inside this story that most analysts are walking right past, not because it is hidden, not because it is complicated, but because understanding what it actually means requires a level of market architecture knowledge that the mainstream financial conversation rarely reaches. That number is 6 million. 6 million ounces of registered silver drained from COMEX-approved vaults in a single overnight session. Let us stop right there, because before this number can be understood, the structure behind it must be understood first. Inside the COMEX system, silver is held in two distinct categories. The first is eligible silver, metal that meets exchange standards, metal that could be used for delivery, but has not been formally designated for that purpose. It is sitting in the vault. It belongs to someone, but it is not yet in the delivery pipeline. The second category is registered silver. This is the metal that actually matters. When contract holders demand physical delivery, registered silver is the inventory that stands behind the paper. It is the collateral that gives the futures market its claim to physical reality. When registered silver drains, the buffer between paper contracts and real metal gets thinner. And when that buffer gets thin enough, the entire architecture of the paper market begins to face questions it was never designed to answer publicly. Now place that 6 million ounce drain inside the context of where registered inventory already stood before this happened. COMEX registered silver had already been contracting, not dramatically, not in a way that triggers mainstream alerts, but steadily, quietly, consistently, the kind of drain that does not make headlines, until suddenly it does. And then overnight, 6 million ounces move, not out of eligible, out of registered, out of the inventory that backs the contracts, out of the metal that is supposed to be there, when someone decides they no longer want paper settlement and demands the real thing instead. Historically, when registered inventory has dropped to critical levels, the behavior of the market shifts, spreads widen, lease rates move, the cost of borrowing physical metal for short-term delivery obligations begins to reflect the scarcity that the inventory numbers are quietly screaming. These are not theoretical signals. These are mechanical responses, built into the plumbing of a market that was designed for a world where physical supply was never seriously questioned. That world is being questioned right now, and here is where the vault drain and the margin cut stop being two separate stories and become one single coherent signal. On the same week that registered silver drains at an alarming rate, the cost of holding a silver futures position drops by 22%. Think about what that combination actually creates. Physical metal leaving the system, while paper access to that same market gets cheaper, the real thing becoming scarcer, while the financial instrument representing it becomes more accessible. In a functioning, transparent market, these two events would move in opposite directions. Scarcity of physical metal should increase the cost and friction of paper exposure. It should make the exchange more cautious, more conservative, more protective of the registered inventory that remains. Instead, the friction was removed. The door was opened wider, precisely when the room behind it was running empty. This is the pattern that serious market historians recognize, not because it is unprecedented, but because it has a shape, a sequence, a fingerprint. Physical drain plus paper loosening in the same window, with a macro catalyst sitting one day away, is not a coincidence to be dismissed. It is a configuration to be studied, because the institutions that move in this market do not react to data. They position before it arrives. And right now, the positioning data that follows this margin cut has not yet been fully revealed. That data, the commitment of traders report, the open interest shifts, the directional bets being placed tonight, that is where the real answer lives. And that answer points directly at one specific group who benefits most, when squeeze risk is highest and margins are lowest. Short sellers, paper traders, and the architecture of market control. There's a question that separates the serious market participant from everyone else in the room. It is not what happened. It is not even why it happened. The question that matters, the one that actually produces actionable intelligence, is always the same. Who benefits, not in theory, not in speculation, but structurally, mechanically, based purely on the architecture of incentives that this sequence of events has quietly constructed? To answer that question precisely, one document must be understood: the Commitment of Traders Report, published every Friday by the CFTC. The Commitment of Traders, the COT, is the closest thing to an honest map of who is positioned where in the futures market. It breaks participants into categories. Commercial traders, these are the institutions, the producers, the banks, the entities with direct exposure to the underlying commodity. Historically, they are the largest short holders in silver. They use the futures market to hedge physical exposure. But hedging and speculative shorting can wear the same coat. Then there are the non-commercial traders, the managed money, the funds, the speculators. These are the traders who chase momentum, who build long positions when silver rallies, and who get systematically removed from the market when margin requirements rise. Sound familiar? 6 consecutive hikes, 6 sequential squeezes on exactly this category of participant. The leveraged speculative longs washed out, 1 hike at a time. Now the margin drops 22%. And the question the QOT data will answer is this: who re-enters this market first? If the non-commercial longs return, if the speculative community rebuilds its long positioning, then the narrative of bringing liquidity back to a thinning market holds some structural merit. The exchange needed volume. It reduced cost. Traders returned. That is a clean, functional explanation. Uncomfortable in its timing, but logically coherent. But if the data shows something different, if what follows this margin cut is not a rebuild of speculative longs, but an expansion of commercial short positions, then the interpretation changes entirely, and it changes in a direction that every serious market participant in this audience needs to understand before tomorrow's open. Here is the mechanics of that second scenario. Physical silver is draining from registered vaults. Squeeze pressure on short holders is building. A short squeeze in silver is not a theoretical risk. It has a historical precedent. It has a documented anatomy. And the entities most exposed to that squeeze are precisely the commercial short holders who have carried significant short positioning through the entire duration of this metals rally. Now margins drop. The cost of carrying a short position decreases by 22% overnight for an institution holding thousands of contracts. That is not a minor adjustment. That is a material reduction in the cost of maintaining a position that squeeze pressure was making increasingly expensive to hold. Think about what that means structurally. The physical market is tightening. The paper market just got cheaper. And the entities with the deepest short exposure just received a cost reduction. At the precise moment their risk was highest. This is not accusation. This is architecture. The structure of incentives does not require intent to produce outcomes. It only requires positioning. And the positioning data that follows this cut will speak with a clarity that no official statement ever will. There's a pattern that repeats across every major stress event in the metals market. Exchange rule changes, margin adjustments, inventory reclassifications, they do not announce what they are doing. They simply create conditions. And those conditions always seem to benefit the same category of participant at the same critical juncture, in the same direction. The ones who understand this pattern do not argue about intentions. They read the COT, they track the open interest shifts, they watch whether registered inventory stabilizes or continues to drain after the margin cut takes effect. They watch the spread between spot and futures, they watch the lease rates, they let the data construct the verdict, because the data has never needed help telling the truth. And tomorrow, that data will have a companion, a macro trigger, sitting on top of everything this story has already built, a number that moves currencies, shifts rate expectations, and historically has ignited silver at exactly the wrong moment for the wrong participants. Jobs data, dollar reaction, and silver's ignition point. Every story has a moment where all of its separate threads stop moving in parallel and converge, where the individual data points that seem disconnected, that seem like isolated market events, suddenly reveal themselves as components of a single unified setup. This story reached that moment tonight, because tomorrow morning at 8:30 a.m. Eastern Time, the United States Bureau of Labor Statistics releases the Non-Farm Payrolls Report, the NFP, the single most market-moving data release on the entire economic calendar. For those encountering this number for the first time, here's what it represents. Every month, the Bureau of Labor Statistics measures how many jobs were added or lost across the non-agricultural sectors of the American economy. It is the broadest, most comprehensive snapshot of labor market health that exists in the financial data universe. And the reason it moves markets is not the number itself. It is what that number tells the Federal Reserve about the trajectory of interest rates, strong jobs number, economy running hot. Federal Reserve has less urgency to cut rates. Dollar strengthens. And historically, a stronger dollar puts pressure on dollar-denominated commodities, including silver. Weak jobs number, economy showing strain. Federal Reserve gains justification for rate cuts. Dollar weakens, real yields compress, and silver, which carries no yield of its own, becomes dramatically more attractive relative to yield-bearing assets. That is the binary at its simplest form. But tomorrow, this NFP does not land in a simple environment. It lands inside a market that has already been structurally reconfigured by everything this story has documented. Scenario 1. NFP comes in strong. Jobs beat expectations. Dollar rallies. Conventional wisdom says silver sells off. Paper traders newly returned to a cheaper market. Reduce exposure. Price pressure builds on the downside, but registered inventory continues to drain. Physical demand does not respond to paper price signals the way it once did. The divergence between paper price and physical availability widens further, and the squeeze pressure that a strong dollar was supposed to relieve does not relieve. It simply goes underground and builds with greater force. Scenario 2, NFP disappoints, jobs miss expectations, dollar weakens, rate cut probability rises overnight. Silver responds. The speculative longs that re-entered after the margin cut now have directional momentum behind them. Open interest expands, volume returns, and the registered inventory drain that was already at critical levels now faces a paper market that is simultaneously growing in size and shrinking in physical backing. Scenario 3. NFP comes in line with expectations. No clear directional signal. Market enters a period of interpretation. And in that interpretation window, the dominant narrative is not the jobs number. It is everything underneath it: the vault drain, the margin cut, the QT positioning, the physical scarcity. In a directionless macro environment, the structural story becomes the only story. And the structural story is spun and unambiguously pointing in one direction. This is the convergence point. This is where margin policy meets physical reality, meets macro catalyst inside a single 24-hour window. For the business community watching this, for the entrepreneurs and decision makers who came to this channel not for entertainment, but for strategic clarity, here is the single most important variable to watch before tomorrow's open. Watch the dollar index the moment NFP releases, not silver's immediate price reaction. The dollar first, because silver's true directional move will follow the dollar's response, not precede it. If the dollar spikes and silver holds, that is the physical market. Refusing to follow the paper signal, that is registered inventory, speaking louder than the jobs report. And that is the confirmation that everything this story has built toward is not a theory. It is a structure, already in motion, already positioned, already draining. The margin was cut. The vaults shed 6 million ounces overnight. The timing raised questions that official narratives did not answer. And tomorrow morning, the final variable enters the equation. The data will speak. It always does. The only question remaining is whether you are positioned to hear it.